as I sort of thought of what should be my introductory sort of remarks in getting the panel going, I think the most apt one was we very nearly ended up with having only 3 panelists here, and I think that's exactly what we're talking about, is how do we make sure that we get the transport systems sorted out in Africa. I'm very glad that we've got all 4 here. So if we talk about transport, I think we'll all agree that multimodal transport can contribute significantly to the growth of any region. In Africa, sadly, this, the integration of the various transport systems and so on is not the rule. I think some studies would estimate that transportation costs increase the prices of African goods by up to 75%. And we think there's quite a few themes that sort of contribute to this, quite a few issues. The first issue is that Africa would have a whole number of landlocked countries. And inland transport and the complexities of it is definitely a contributing factor to the woes that we're currently experiencing. The next point really is the port-to-rail link and whether that is working effectively. I think most delegates here would have a story to tell about how congested some of the ports in Africa are, how difficult it is to get containers from port to inland. There's some very specialized rail and port facilities that are vertically integrated. I think they work well, but they're few and far between. Financing mechanisms, our MC mentioned. My panel here will start talking a bit about that. We can't really talk about transport in Africa without touching on the subject that the development of transportation systems and infrastructure is impeded by administrative, regulatory, and governance barriers. The most serious impediment is probably the administrative one. There's been studies that show that the administrative burden linked with small-time corruption could increase the cost of transporting a standard 20-foot container from South Africa to Eastern Africa or the Far East by up to 14%. We've mentioned the real challenges that landlocked countries bring, the fact that land distribution of exports in landlocked countries can take 4 days longer than if you're not a landlocked country, 9 days for imports, and all of these times are highly variable, so it's not even sometimes possible to get a dependable schedule going. And the last thing that I think we'll touch on a bit is that in improving the efficiency of transport services, I think everyone would agree that you need a liberalized transportation market that gets the right balance between public and private interests. Strong competition is definitely needed, and in most markets, the competition has been increased by expanding the role of the private sector. So with that as background, let me quickly introduce you to my great panel. Right next to me is TGAIS Avaneropur. She is with Africa 50 of the African Development Bank. Then Charles Okealam, Managing Director of AGH Capital Group. Uche Orji, Managing Director and CEO of Nigeria's Sovereign Investment Authority. And right at the end, Roman P., the Executive Head of Transactions of African Infrastructure Investment Managers. Taz, maybe I could ask you to just quickly introduce yourself, tell the audience who you are, what you do.
Yeah. Good morning, everyone. I used to manage actually African Development Bank's private sector infrastructure finance business for the last 6 years. But a year ago, I was tasked by the president to set up a new infrastructure vehicle called Africa 50, which will be tackling with the challenges and is going to operate in a very commercial way. So that's it.
Thanks. Charles?
Thank you very much. I am a co-founder of an investment holding and private equity business based in Johannesburg. And we have, with some partners, bought into a piping business, a transportation road haulage business, and a drill heads business, which is used for mining equipment business, mining deep mine sites. That's primarily my background. I'm an economist by training.
Thank you. Uche?
I am the CEO of the Nigeria Sovereign Investment Authority. And we have 3 funds that we run. But the one that's relevant to this conversation is the Nigeria Infrastructure Fund. Our experience investing in transport infrastructure or any type of infrastructure in Africa is limited to Nigeria, so my commentary will be from a Nigeria perspective. We've made commitments. We're co-developing a toll bridge and toll road in transport and also just made a recent commitment to another toll road in the country. So there's a lot to talk about from those two experiences, I believe.
Thanks, Uche. Romain?
Good morning. I run the transaction team of African Infrastructure Investment Managers, which is the JV between All Mutual and Macquarie. We got around $1.3 billion under management spread across 5 funds. We invested in toll roads, in renewables, in power plant, and generally are quite a generalist infrastructure fund.
Thanks, Romain. Before I start peppering questions to the panel, I just want to sort of extend an invitation to the audience as well. I think we would all very much like for this to be a very interactive session. I think there's quite a few questions in the room that I've seen from previous panel discussions. So if anyone has got a question, please put your hand up. I'm sure we'll get a mic to you and we can start. Taz, if I start with you, can you maybe just touch a bit on Africa 50, what you do? We've all heard stories that of total transport projects in Africa, 50% of total project costs can be made up of development and structuring. Can you talk us through about, Africa 50's vision?
Well, thank you. I think this is a great opportunity to make everyone understand a little bit more about Africa 50. I am sure everybody was hearing in the market, we were talking about Africa 50 for the last 12 months. Africa 50 was established as a separate corporation from the African Development Bank as of September 4th, and we are a very new organization. But what we were doing actually the last 12 months was structuring, designing, fundraising, and also preparing the operations of Africa 50. As such, once it is established, we can pick up the operations and immediately we start providing financing and co-development capital. As you know that African Development Bank has 2 different windows. One is public sector financing, through which we were providing financing to infrastructure projects to governments for the last 50 years. But 6 years ago, we established private sector window, through which actually we finance PPP and private infrastructure projects. Actually, our record in the last 6 years was amazing. We did 49 projects, and we put $3.1 billion from our resources. And through syndication, which is also something new for African Development Bank, we brought another $4.6 billion from other resources. And through those tools, actually, we facilitated $32 billion investments in the continent in infrastructure. When it comes to transport, actually, we put our signature under very, very game-changing special projects, such as Dakar Toll Road, Dakar Airport, and Fida Airport in Tunisia, and the first toll bridge in Ivory Coast, which was done right after the civil war ended. When you look at all those projects, and also some support to like through corporate loan, $1 billion to Transnet in South Africa, actually all of them are done in a public-private partnership model. Having said that, with this success, we came to a level and we look at still what is needed in the continent. And that triggered a different kind of thinking. Yes, we are very good to respond to the market, but we are not good enough. And we are not able to meet the market's expectation. As such, we decided to create a new vehicle, which is called Africa 50. Africa 50 is an innovation, and we believe it's an innovation. Its design reflects actually our experience in the last 6 years in PPP projects and also privately financed infrastructure projects. And Africa 50 works on transport, energy, and ICT water sectors, but the model of Africa 50 is a one-stop shop. As you mentioned, in Africa, any project from idea to reach the financial close, believe or not, 7 to 10 years. Any project, those 49 projects, when they come to African Development Bank for financing, except 47 of them, we have to go back and restructure the projects. And it means that we have to spend another 18 to 24 months, sometimes 36 months to restructure those projects, renegotiate all the contractual agreements. So why not? Instead of restructuring, let's structure those projects. And second thing, most of the governments, they don't have the capital to develop projects. If you look at today in Africa, development capital can go all the way to the 20% of the total project cost. And the minimum in Africa is 10%. What is the benchmark around the world? 3 to 4%. What is the reason behind that? Number one, governments, they lack resources, both human and capital resources to develop projects to bankability to offer the private sector. But at the same time, private investors, they are not sure to get into this area because they are not sure when they are going to get their money back. As such, a new way of looking project development is needed. That's what Africa 50 will be doing from the first window. We will be co-developing projects with private sector as well as with the governments. When the projects come into bankability, we will be bringing other partners, such as operators or EPC contractors. We will do this in a way, it's not going to be like business as usual, like we used to provide grants to the government. We will look at from the commercial perspective. When we reach the financial close, we will take our development capital and small premium and go to the next project, meaning that we will continue to recycle our capital. And project development component will not be funded by donors, but it will be investment by the world-leading companies and specifically African Development Bank. African Development Bank put 100 million into this component to show people as the cornerstone investor, we are going to put our resources and skin in the game. Second component will be another one-stop shop, project finance. Our experience shows that many projects, they get to the financial close, almost we are there. 5% equity or 5% debt is missing. And what happens? Another due diligence process, 18 months, 24 months. Why not? We close that gap, project starts the construction, but we later sell that in the market. Our product tray for the project finance component is very large. We can do bridge equity, we can do bridge debt, we can do mezzanine, we can do senior debt, we can also provide different kind of risk mitigating products, but we can also do refinancing. The whole idea is continuously recycling, continuously supporting the project. As such, we save the time from idea to reach the financial close and operations. Once the projects are reaching the operation, it is very easy. Then we can bring institutional investors. So, let me give you an example, because we are in the transport section. I think it is important to give a real example. We signed a joint development agreement with 3 governments. Those projects actually between multi-governments are quite difficult and is very time-consuming. First of all, Kenya, Uganda, and Rwanda agreed with Africa 50 to co-develop this specific railway project, which is $15 billion, which will start from Mombasa, reach all the way to Kigali. Africa 50 is co-developing project in its manner. We share the risk, but we share the development capital as well with 3 governments. We have 3 phases. First phase, all of us, we put equal amount for the development capital. Second phase as well. Third phase, we bring the private sector. As such, when we reach the financial close, 3 governments and us, we take our development capital and small premium, we go to the next project in the same countries. This tells you that actually we will be able to change the game, especially for large and also multi-country projects. But the other advantage of Africa 50 is, it is a brainchild of African Development Bank, which has convening power with those countries, meaning that we will be sitting on the table as the honest broker and helping both parties, private and the governments, reach the financial close as quick as possible. We have done this in Dakar toll road. We have done this Dakar airport. We have done this also in Ivory Coast toll bridge. I believe that our involvement made it very quick and very sustainable, especially in the Ivory Coast toll bridge. Actually, reaching the financial close was only 6 months. 6 months later, everybody wanted to be part of that project, and African Development Bank had to scale back its amount put as a loan. So when you look at actually this model, it is a game-changing model. And we believe that through this model, we will be able to work with large scale and especially large scale infrastructure projects in transport. Thank you.
Thanks, Des. I think that makes sort of quite a lot of sense, and it's something that gets people thinking about it. You mentioned a number of times that you need to bring the private sector sort of into this and make sure that we get private sector investments and so on. And I want to get onto that bit, because sometimes you get the sense the private sector is quite reluctant to make investments either in transport infrastructure or without the necessary transport infrastructure in place. And Charles, I was wondering whether, we chatted quite a bit about the effectiveness and how do you make sure the private sector gets involved, especially to finance transport infrastructure?
Yeah, thanks very much for that, Wildo. I think there are 3 issues there. The first issue is to do with optimizing the private-public mix. The second issue is to do about optimizing the debt-equity mix. And the third issue is to do about credit enhancement overall. And let me just stay with the first issue and start with that. As Taz has pointed out in her description of what Africa 50 does and the ADB does in this context, it's about getting a partnership that will work effectively and that gives the private sector the kind of guarantees, the kind of incentives to actually put at risk money, private sector money, and expect that return to be made. And it's in that context that a number of projects actually fail simply because the private sector asks for these guarantees, and unless there is an agency or an institution that can play that role, that facilitates that relationship effectively between the public sector and the private sector, then there is a problem. And there is a big difference in this context with regards to the project set at what I would say anywhere above 50 million. In that case, you would expect about 13 million to 15 million of equity, and you would have some mezzanine structure, and then you'd have a debt position. And the larger scale projects, because what we have seen is that the larger scale projects are in fact easier to finance. The analysis and the work that we've done looking at opportunities in the transportation sector, we find that there's a critical point where capital is relatively cheaper. It sounds perverse, but that the private sector will be more willing to participate in that. And when you examine it carefully, it's not as perverse as it actually sounds, because some of the packaging issues, the legal issues will do, the legal costs will do, and the costs of bankers and the costs of services makes it that you find it's easier to scale up and do bigger regional projects. Therein, you then have the problem, which is if it's going to be a large-scale transportation project, it's typically going to be one that crosses boundaries in a number of countries. And there are jurisdictional issues and different countries willing to pledge different forms of guarantees to enable that private sector money to come through in the process. So it's about optimizing that public-private mix effectively. Now the issue of optimizing the debt-equity mix. And therein is the different issue. Of course, you can have all kinds of structures where you subordinate the debt. You make it possible that you put different structures and tranches of financing. But equity players find it, from our experience, are not willing to write the large-scale pure equity checks unless they have an agency, once again, that plays that underwriting process. And this is simply because of the first reason. For an equity player looking for the return on equity required, a benchmark required, they typically would benchmark that against an equity play in the capital market or some other form. For the debt player, it's straightforward. You benchmark it against some sovereign bond or some aggregated value across the bond structures that you are financing in the region, the area. And when you do that, it's easier than you do a long-term structure with a bond structure, and you look for that return. The issue is that a number of projects, depending on the countries that you select in your basket, and because by definition transportation to be most effective has to be on a larger scale and regional, some of those countries, their bond ratings, when you compare them to a straightforward purchase of a bond without going to a wider scale, you find that some of those ratings make that project not as economic as you would want them to be. Hence, once again, the role of DFIs. Hence, once again, the need to securitize and effectively structure the investment. And then the last thing, which is linked to the second, and of course they're all linked, is the issue of credit enhancement. And I think that's where an institution like the ADB and other development institutions. In Southern Africa, we have an institution called the Development Bank of Southern Africa. In West Africa, we have the ECOWAS Bank. In East Africa, we've got the Commerza Bank. And that's where a number of these institutions have a critical role to play in reducing the overall cost and play that agency underpinning role. And let me say, unfortunately, in many instances, they would have to take first losses in the structuring if, in fact, it goes wrong, if the projects go wrong. And they have to give those guarantees to the private sector to ensure that they play the role that they would like to play, and we encourage more private sector flows to take place.
Charles, thanks. You mentioned something interesting there where you spoke about the ability, or hopefully moving in that direction, of securitizing almost these projects. Can you just sort of share your thoughts on that with us? Do you think there's a role for credit agencies to play, for instance, to start looking at projects? And
certainly. Let me just expand a little bit more there. You see that I think that as Africa gets more and more discovered, and it stops being a frontier market, I don't know when that's going to be, but I think it's going to be soon. I hope it's going to be soon. And as the previous discussion on capital markets explained, there's greater capital market integration. As these forces and these forces confluence, I believe there's going to be increased transparency. And as that takes place, I believe it's going to be possible to package projects, list those projects, and get the appetite to be able to get investors buy listed securities which represent actual projects. And that might be a way off, but I think as the market deepens and as there's increased transparency and knowledge, I believe that's a possibility.
Romain, I know you've got a few thoughts on that as well.
Yeah, I was listening to the argument, and one thing which I found quite interesting, if you just look like, what is the biggest investor risk we face in infrastructure in Africa? Currency risk. What is the other continent, what they've done? And that I think is quite interesting. The two sectors is in Asia, in LATAM, where people have packed capital into, are ports and airports. Why? Because you got this hard currency link on the revenue side. Africa Container Terminal has been a massive success story for the Bolloré, the APMT, and the others. Now, you're asking two different things. The private sector has taken full traffic risk on those assets. What you're asking when you say we need to put an agency in the middle, I think often you're asking question, who is best to take the risk? And there's been in a number of countries, we go back to tequila crisis in the 90s, I mean, some of our Citigroup banker could definitely attest on that. What has been, at one stage, the toll road was structured in such a way that the traffic risk was a way passed to the user and backstopped by the government. When devaluation happened, none of the counterparty could basically back the obligation. So, that's not the right risk allocation. So you need to think, what are the sectors where you should facilitate first the capital going through? And if you develop, a lot of African countries like Brazil, like Chile, having a lot of commodity natural resources to leverage the asset base on it. But everyone wants to do single user. You need to go multi-user. You need to think, what is the pool of capital you can mobilize? You mentioned, TAS, what's the only PPP on the airport space? And FIDA in Tunisia.
Dakar Airport as well.
Dakar, there is no, it's an O&M it's a management contract. There's not been capital on that. We've not seen a wave of privatization in the scale that we have seen on the container terminal sectors. We have not seen this wave going through the break bulk asset. And, when I hear for example, I take a bit the rail project you mentioned. I'm a bit, I don't know the project very well, but $15 billion, it's very big. I mean, VLI in Brazil traded at less than 2 billion. You got a bigger country, bigger cash flows, and they've not been able to sustain a $2 billion project. 15 billion sounds enormous. What is the flow of commodity going through that to support such an investment? And that, just if the equation doesn't stack up from early days, the private sector is going to be scared about that because they don't see a very straight answer. No, we had a little discussion ahead of the panel and about a certain project in Nigeria with traffic risk. And I think that what the private sector concluded is there wasn't enough volume, so cars, basically to support the bridge. And I think that's where we need to be just careful. How do we structure, which project do we approach, and having this discussion, and a frank discussion.
I mean, I already see Taz nodding, shaking her head and nodding at the same time. I want to ask, and then I want to get on to Uche, because you also got into the Nigerian bit there. Taz, just quickly your thoughts on that.
I think in Africa, we have to stop, number one, the pessimism. Number two, comparing Africa with other places. I'm sorry, Romain. We have quite a bit successful stories. Look at Dakar Toll Road. I still remember, like 3 in the morning, arguing about the traffic numbers, if anyone is going to use this toll road or not. And I remember that we have done 3 traffic studies. Each one cost actually more than $100,000. And then finally, it was agreed that it's going to be 15,000 vehicles per day, and by 17,000 vehicles, that is the threshold, there will be a profit-sharing mechanism between the government and the operator. And you know, today the number is over 20,000. And we are doing the second phase of Dakar Toll Road. This is one of the most successful program actually in Africa. I mean, Mpida Airport is the same. Yes, it's true, the 15 billion is enormous, but we are actually lacking development and growth because we don't have those kind of projects. You have many mining in northeast Congo. How you are going to open that mining to the commerce if you don't have this railway? I mean, somewhere you have to start. It's not going to be 100% financed by the private sector. It will be 50 to 60% like other projects in South Asia or United States by the government, and the rest will be from the private sector. And we have different mechanisms, and we are currently looking at 6 different scenarios for financing of this project, but somewhere you have to start. And that's why actually we are created, not only Africa 50, African Development Bank itself as well, because the most riskiest part, we have to actually make it happen so we can provide the platform for private players. But if we say that $15 billion projects are big and we are not going to work on this, so we should forget about like large projects like Simandou in Equatorial Guinea, Guinea-Conakry, and we should forget about the projects like the Tanzania Kigali Railway. So I think somewhere we have to take the courage to do those kind of projects. These kind of projects are not going to be actually financed only one party, but it will be a consortium. Also, operation will be by a consortium. I think people like us, we are here to structure these projects all together under a partnership program between private equity or Africa 50 or African Development Bank, but we should not be scared of these large projects.
Uche, we've chatted a bit about, and we touched on this here, the issue of Nigeria, just as Romain was sort of talking there. And so Africa's largest economy, I think there seems to be quite a few specific issues with this sector in Nigeria. Your thoughts about policy and getting projects authorized and approved, can you maybe share that with us?
Yes. I think there's so many things that are not properly understood about this asset class in Nigeria. Number one, the concept of private investment in public infrastructure is new. Okay, so you can't, from where you are today, expect the institutions to be ready, expect the pool of capital to price this risk appropriately. So there's a lot of things that you have to invest today, contextualizing where the country is or where the continent is. I'm going to address probably 3 things. One is following up from what Charles talked about, which is the need to have an institution come into the middle. The second thing is just understanding the role of credit enhancement and how we define the role of credit enhancement. I think it's important that we take a slightly different approach, because the idea of asking somebody like ADB or anybody else to take first loss equity doesn't always work. So we must find a way to address the issue of credit enhancement if it's needed. And then the third is to explain what an institution like NSIA is set up to do. What we are set up to do, and conceptually, across Africa today, you're seeing sovereign wealth funds start up. And the reality is that we are investing in a slightly different model from other sovereign wealth funds. On the one hand, we have 60% of our assets invested abroad, which serves as a hedge to the local economy. But we also have 40% of our assets invested or committed to be invested domestically in infrastructure. We decided, out of what we saw as 18 investable sectors, to start with 6. And those 6 are toll roads, and I'm going to talk about the debate going back and forth because I'm in the middle of one, and I understand exactly both sides of the argument, and I can tell you what it takes to get it done. Power, gas processing and transport, where we've just made an investment of $100 million in a local gas processing company. Healthcare, which we still define as infrastructure, frankly, because a lot of the issues in healthcare in Nigeria isn't about the lack of qualified doctors, it's about providing the right infrastructure for them to operate. And then finally, agriculture infrastructure. These are the 6 sectors we wanted to start with. We've made commitments in just about all of them equally. What is the role of the NSIA and institutions like ours? It's government capital, but we run it like a private sector entity. And we expect that institutions like this will catalyze the role of public-private partnership in Nigeria and in Africa across the board. Because the issue with government capital is how does it come with the governance and structuring of a private sector entity? It can't unless you have an institution like ours that is set up to run like a private sector entity with government capital. And we're hoping that we start to bridge that gap, because when we start to look at the key issues of a toll road or any of the power, any other infrastructure in Nigeria, it's important that we define our roles properly. We see ourselves as any other pool of capital in terms of how we price risk. So we price it the same way the private sector will price risk. We can invest across the entire asset class. We've done debt, we've done equity across the entire asset class. We would like to just remain as investors, but we've also found ourselves stepping into co-development roles and stepping in sometimes into sponsorship roles. The point here being, because many things are not developed, institutions like this are necessary to bridge that gap, and this is why I think the concept of the African Sovereign Wealth Fund, which is set up not entirely the way you see any of the sovereign wealth funds set up either in Europe or in the Middle East, is very important. We are doing both domestic infrastructure investing and we're doing foreign securities investing as a way to hedge the local economy. Now, specifics. When you come to investing in a toll road in a place like Nigeria, there are 2 types. There's obviously brownfields where there's a sense of what the traffic is, and there's greenfield where you don't have a sense of where the traffic is. The government, we have come to a point where they understand that certain guarantees are necessary and need to be provided to underwrite traffic risk, to underwrite certain other risks that people will take. It's taken a long time to have those conversations, but of late we've made some success, and I think they're beginning to understand that that is necessary. But what I will say to the private sector capital provider is when you come to have those conversations with government, be prepared. The governments today are much more sophisticated and won't just hand you a blanket guarantee. So you have to be prepared to make concessions on your side, have an appropriate risk register, and price it appropriately. This is the discussions we've had with the government for the last year on a project, which is the Second Niger Bridge, which frankly is not just a bridge, it's a bridge and a road that totals about 40 kilometers altogether when it's completed. So pricing that appropriately has been very, very interesting and been a great experience for us. And I think we've come to a point where the government is beginning to understand the need of the private sector and are willing to provide some of the necessary guarantees via things like put-call option, obviously, which I think is going to help us get such a project completed. However, a much more robust credit enhancement is necessary from our view. And as a consequence, we've been working on a facility called the Nigeria Credit Enhancement Facility. What is the point of this? Look, there's a limited pool of resources the government can deploy into something like this. So we decided to take the bull by the horns on ourselves and create something similar to a monoline insurer that provides a certain level of enhancement. What will this do? Existing assets of the government, for example, where there's a clear understanding of what the traffic is, why could the government not issue a bond on those assets? And a facility like this can ensure a certain pool of that, which then attracts pension funds and insurance companies who do not today play in that type of asset class. My sense is that this does 2 things. 1, it deepens the bond market. 2, it allows the government to unlock equity in some of these assets. And 3, it attracts other pools of capital today that are not part of the asset class. It's new. It hasn't been tested. We haven't actually launched it. We've been working on it for over a year. But hopefully at some point, I believe that all the evidence we have seen from our initial piece of work on this is that something like this will work. Everything is needed. This is just 1 tool out of many tools, in my opinion, of what is needed to provide great enhancement. And for this toll road, for example, my sense is that at the exit point, this facility will help bring in people that can offtake the capital that has been implemented in it. The final point I want to make in terms of what I think are some of the key issues is regulatory. For everything we're doing today, we're realizing that we're writing a template for how investments is made in this area. And people need to approach it knowing that all the regulatory tools are not ready. For example, who sets the traffic, who regulates the traffic, who regulates the tolling? Who sets the pricing? How is that regulated? These are new. It hasn't been set up yet. It's something we're setting up across with the government. So when you come to this, you have to approach it from a standpoint of view that things are not yet entirely fully developed. However, this is priced appropriately. We are going into this expecting to make a significant return, in my opinion, that actually takes over, actually offsets some of our perceptions of these risk issues. So all in all, what am I saying? Number one, institutions are being built. We're there in Nigeria as that institution that plugs the gap between the public and private sector as we start to look at infrastructure. And across most of the other sovereign wealth funds I see come up, this is part of their mandate, and I think this is going to bridge an important gap in terms of how we see it. Number two, there's capital to invest. Government capital that we have, there's other pools of capital that we're trying to mobilize. Three, credit enhancement is important. However, governments have become much more sophisticated when you start negotiating guarantees. 10 years ago, you could come in and then you get a blanket guarantee. Not anymore these days. These things can take many months to negotiate and come to the point where we'll agree. But then there are also other tools we're looking at to bring credit enhancement, which I think is absolutely necessary. I'll stop here.
Thanks, Uche.
Willow, thanks. But then I want to ask you then, Uche, how is the role of the NS, the Nigerian Sovereign Wealth Fund, different from the role that was explained by Taz here to some extent? And when we talked about the agency role,
Sure.
we talked about the fact that if you look at naked risk and you price naked risk for some types of infrastructure, what you get is a misalignment. What the person says is, why would I fund or finance? And I want to just, I must be careful because I once said in public that, that the private sector doesn't fund anything, it finances things.
Sure.
And there's a distinct difference between them.
Absolutely.
So you fund something and you take on the social costs of the issue that you're funding, all the rest of it. But my issue then is, when I listen to you, in effect, you were basically using a different thing and focusing on Nigeria, more or less saying what Taz was saying on a Pan-African basis, right? And the issue is that for a lot of our infrastructure challenge on the continent, there are commercial opportunities,
Sure.
right? But those commercial opportunities also carry with them high social costs, right? And they have social bundles which make it very difficult to just simply finance them. So you end up funding them. So when you explained the role of the Sovereign Wealth Fund, you actually then said, or more or less mirrored it, focusing on Nigeria,
Sure.
about that role that you have to play in what? Developing the project, pre-feasibility, and you said, and sponsoring the project in effect. Now, I think that is the big challenge, because most times investors come along and they can clearly see the opportunity. The opportunity stares them in the face. It's a port. It's a railway. We looked at a railway, a very interesting railway, for example, that runs through Zimbabwe, Zimbabwe to southern Zambia, NLPI. Wonderful railway, very profitable, by the way, which an investor wanted to sell. But then a government, and I can't say which one, has then asked us to extend, if we're to buy this concession, extend the railway to an area where it doesn't make much sense for anybody on a commercial basis to do so.
Sure.
Now, that is the reason why you now have the role of the Africa 50 and the role that you play. So I'm just wondering whether or not you could give us a view as to how what you do is any different from what I understand Africa 50 does for the African development.
I think in many ways, Taz and I have been in discussions about how our roles.
Oh, you've been in discussions
for 2 years now. So for 2 years, it's an ongoing conversation. What we do is a narrower subset of what Africa 50 does. We both identify two things. Number one, project preparation is a problem. Like I said, I would just like to invest. I don't want to co-develop. I don't want to sponsor. But this asset class is still very new. So I found myself co-developing a bridge on a road, which honestly I wouldn't like not to. I found myself having to take 1.5% of our fund to set aside for project development. It's an investment we make, and we actually get that paid back on financial close. But somebody has to take that risk, because otherwise some of these feasibility projects, when it's in front of you, you can't invest in it. There's nothing to go from there to a term sheet, there isn't. So you have to find yourself sponsoring. We spent so much money on ESIA, which I wouldn't like not to do. We spent so much money on making sure supervising compensation payments. We spent so much money reviewing the cost from the EPC contractor, for example. All of these things you do from a project preparatory standpoint, we're finding ourselves having to do. I ideally would not like to do it, but I also know if we don't do it, the asset class will not develop. We'll not be able to make the investment. So yes, Africa 50, NSIA, again, this is I would like to say NSIA started before Africa 50 was launched, but Tas and I have been discussing these issues since 2012, frankly, as to how do we get, and it's an Africa-wide problem. My focus is Nigeria, obviously, because economy in Africa, but this is an Africa-wide problem across the board. And so you're right, we're doing exactly the same thing.
There's your
let me add something. I'm going to come back to the Dakar toll road. I think we had similar models in number of transport projects in the continent, but Dakar toll road is one very successful story. And I really want to talk about more successful stories in Africa. As such, we can get influence from those and do more of them. Dakar toll road, actually, it was not commercially interesting for any private party. Then our discussion with the government actually resulted, we convinced the government to put $56 million into the project as the viability gap funding. As such, the project becomes something very interesting for the private sector. But at that time, government didn't have this $56 million ready. So what we did was actually, we did a public-private partnership inside the bank. Through the public sector window, we provided $56 million to the government. So as such, they can put that as a viability gap funding in the project. But from the private sector window, we provided financing to the sponsors as such, like the senior debt will be completed. So you can create number of models, and then in return, actually, of this viability gap funding, after certain threshold, actually, profit sharing mechanism starts. As such, project is sustainable. Little bit like the risk and risk appetite of people. I think risk is exaggerated for Africa. I believe that strongly. I mean, I personally closed 49 projects in the last 6 years, and many of them operational. And I can tell you that most of them are actually priced commercially because we follow the market price. We don't give people subsidized loans from the private sector the window. And when you look at all those 49 projects, I don't have $1 write-off. Where is the risk? If the project is well structured and actually you are able to bring all the players together around the table, the government, investors, and the financiers and sponsors, I think you can cut a very good deal because everybody has one goal. Let's make this project happen. Once you work for that goal, it happens. When it comes to the smaller projects, Charles, I always give this example. I have a beautiful project in Cape Verde, which was $65 million. Actually, $65 million, we put $15 million from our resources, and you do a loan of like $500 million, or you do a loan of like $15 million. You do the same work. But actually, that was a beautiful project, and we looked at all the return mechanism and the cost-sharing mechanism. It was a good project, so we financed that project as well. Why we got into project development? If you look at what is needed in Africa, you need $100 billion investments every year, and 50% goes unfunded. Why is that? Mostly the other 50% is funded by the governments or development finance institutions. Today, the government budgets are not really in the position to invest into infrastructure like they used to in the past. And when you look at the development finance institutions, actually that's where we looked at ourselves, where we are going wrong. And if we want to change the game in Africa, what needs to be done? We are not able to increase our capital because we are funded by our donors, and they're having financial problems. So that's why Africa 50 model is an investment corporation. It's a public-private partnership. African Development Bank put $100 million to project development, $500 million to project finance component. We also have commitment, almost $650 million from 12 governments in the continent, and we believe that this will go to 54 governments in the next 14 to 16 months. Why we created like this? Because it's a public-private partnership. It shows to the world that actually we have the political commitment from those countries. And now we are ready to go to institutional investors. We are talking to institutional investors. Our goal to reach $3 billion base capital and single A rating, so we are flexible. We will not go to the AAA, right, African Development Bank, which will give us flexibility. So then we can actually raise bond 2-3 times in the markets and create more $6 to $7 billion capital and sell those bonds to central banks and pension funds locally. As such, we mobilize African capital for African infrastructure. I think I created a little bit issue last year when I talked in New York about this, and I asked people in the room, look out of the window, look at this infrastructure. Who's building that infrastructure? Who buys treasury bonds in the United States? So I think it is time for us to use our local resources to finance infrastructure in Africa.
Thanks, Des.
Yeah.
Well, I want to open up the floor to members of the audience to ask questions while our mics get going, and just sort of to get people sort of thinking a bit about it. There's a few questions there. Romain, can you just maybe just touch on one thing, and that is, I think it's quite clear that the reliance on usual sources of funding, taxes, that sort of thing, doesn't really get us to fund all the projects we want to. But there's also quite a bit of constraint on this user pay principle. Everyone referred to toll roads everywhere, and that we also see running into issues. Have you got any thoughts on that? Why is that?
Can I just, before ask a question to Ushe, because I wasn't sure on the securitization of the toll road revenue he mentioned, what was the objective? So the toll roads, I presume, is owned by the state.
Yes.
So what I'm looking is just maybe you're securitizing. What's the aim for the state to take the debt off balance sheet? Because surely the state must be able to issue themselves infra bonds or on tap the market at a cheap. So I'm just trying to understand.
No. I think there's a few other steps before securitization. The first step is to turn them into sustainable private enterprises via concessions. Yeah. So what we've said is, look, these roads are wonderful. You've built them. So what's the model? How do you sustain it? 4 years, 5 years from time, a new political cycle, you spend the money all over again. That makes no sense. So if you start to look at a model where some of these things, the same way we are now having a private company build and operate a concession over 25, 30 years on a toll road, why can't we do the same thing on existing roads already as a way to now have a proper O&M, a proper revenue model that keeps the roads properly maintained. And again, like I said, today, there are no toll roads in Nigeria. There used to be 15 years ago, 10, 15 years ago, but today there aren't any. So if you put them back, obviously these things have social implications, so you have to have a proper conversation about these things. But it's about making sure that these infrastructure investments are sustainable. Number two, it's also a way for, once you sell the concession, a way for you to take capital out as a government participant, but by so doing, you hand it over to private sector that can run it. To make that happen, there are many things you need to do, obviously. One, and probably the most sensitive, is having a national tolling policy, which actually sets what the price of the toll will be across the board. That's number one. Number two is to have a legal environment that allows you to actually concession this, and we've started to do that. One of the two we've done so far is setting a template for how this will be done. And ultimately, the value to the government is, why would the government do this? The government will do this because once it is sold to a concession company, you pay for it. And then you as the concession company can then either issue the bond, or in the case of the government decides to manage and operate it. That's also a way for the government themselves. They can issue a bond and they need to take capital out. So it's all very simple.
I agree. I think you mentioned, it was just, I thought you were going to go this way, so it's good because you half responded to the question of will do. I think one of the issue people have is, from just a capital allocation, often, what you're saying, the National Road Authority doesn't receive enough capital from the budget to maintain the road properly. And, and this is experienced across the continent. And one of the issue, if you like, Sanral has made some public statement on the South African press, and clearly they got an allocation. So let's say they got 100 billion rand they need every year. They receive less than 50% from the budget. Sure. And they do not collect enough tolls across the network to be able to carry all the maintenance. So in my words, we use two words, preemptive maintenance and corrective maintenance. The difference from a cost standpoint is one, you do the maintenance before you have really to repair, to go a pothole and so forth. Why? Because over the long term, it's much cheaper. And I think unfortunately, where the first discussion needs to come is for a lot of government, they don't adopt a user pay model. And what it means is, if your road is driven by a lot of cars, these people should pay helping to maintain the infrastructures. And I think you need to introduce this model more across, and at different level, and over time, to develop something which is, and I think we use the same word, sustainable. Because the road at one stage will need to be maintained, and you need to build the capital to be able to provide that. So some of it, in some, you may need the private sector, in some, no. And that's where, I'm saying to us, in some of the projects, there is no universal way of funding infrastructures. And there is space for both the public sectors, the private sectors, and sometimes a PPP. But I think people need to recognize what the risk each party is ready to take. And sometimes it may be just to be, I take an example here, we're in London, Eurotunnel, okay? Yeah. Should it be a PPP? I think a lot of people think with insight, maybe it should not have been. But that's where you need to define where you draw the boundaries.
I'm sure there's quite a lot, and I'm sure we'll get onto that. I just want to start getting the audience involved in some of the discussions. There was a question there.
Thank you very much. I have just a brief comment, not a question. I think that Ghana is one country which is also establishing a Ghana Infrastructure Fund, passed into law. The reason why guarantees are not the way to go, frankly, is that it passes all the risk to government in the first place. It analyzes, the entire risk. It doesn't distinguish between commercial projects, and social projects. There are commercial projects, which can be funded, fully by the capital markets. And what we are doing, and we are also in discussions with African Development Bank, the World Bank, with respect to using partial risk guarantees and, enabling, our sovereign wealth fund. All that we're doing is taking the oil resources, not as big as, our brothers in Nigeria, but leveraging it to the markets for commercial projects. I think this is a better, approach. I can look at the 100 million contribution to my budget to fund guaranteed projects on an annual basis. I can look at 100 million as a stream of revenues that I'm going to leverage onto the market. And I think this is also part of the skepticism about, the issuing of bonds by African markets. I think it's a maturing process that should be supported by the private sector for infrastructure development. The secret is in escrows. Ghana is very successful with these cocoa bonds. The secret behind the cocoa bonds, which are issued annually at LIBOR plus 2%, is simple. The revenue from cocoa is used to pay, for the loan. Why not infrastructure? Yeah. Why not railway? And in any event, if I guarantee the 15 billion, it is the entire 15 billion which is on public debt. And mind you, when you guarantee a facility in Africa, it is added to your public debt. And our public debt is seen to be escalating. Even if you collect 60%, it is 40% less risk. And I think these are some of the reasons why, we should find new ways, of doing things. In January, we are launching our Ghana Infrastructure Fund in Ghana because we think that is a better way, to go. I do support the Nigerian approach, the Africa 50, approach as a way to move the continent forward. Thank you.
Can I say
so is there some more questions? Shall we take maybe one or two more? Gentleman here. Maybe just identify yourself if you don't mind.
Hi, my name is Raj Kulasingam. I'm a lawyer in London focusing on African infrastructure projects. One of the things that I found advising on African infrastructure projects is that governments have a very different perception of risks to the private sector. So what the government says is a risk that the private sector should take is not what the private sector takes as a risk, or sees it as a risk it should take. And my question to you is, how do you sort of manage this equilibrium, is first question. And the follow-on question is that it's always easier to do the third and the fourth and the fifth and the sixth project. And the question is, the first project is difficult. So on the first project, we should all be looking at maybe challenging our perception of what risk should sit where and saying, okay, first one, let's make it a bit easier for the private sector, a bit harder on the government. And I suspect, maybe I'm preaching to the converted here, but that's the piece that I find that's missing. Because every time we deal with the public sector thinks the private sector is taking the cleaners.
Sure.
Okay.
Sure.
Yeah. That's my question.
Charles, can I just say something at this point?
Ahead,
First of all, let me just correct something I said earlier. Lagos State government has a toll road. So when I said there's none in Nigeria, I meant at the federal level, but Lagos State has something. And we learned a lot from that, from what Lagos State has done on the Lekki Toll Road. To your point as to making the first project easy, that's exactly our pitch to the government on the federal toll roads, is you've got to make it easy for the private sector to participate. And so on the road we're talking about, Second Niger Bridge project, it will eventually cost $700 million, but the government is going to put up the equivalent of $200 million as, I hate to use the word viability cap funding, but it's a Class C type equity with non-voting rights within the vehicle. And a lot of the negotiations, things are being done quickly to make it easy. So the government understands that. And Once you get the first project done, and this is the pitch, get the first project done, we'll have our lessons. And from what Lagos State government has done on Lekki Toll Road, we've learned a lot of lessons studying that and trying to make sure we understand exactly how that's happened. I think you've seen also Lagos State government has done a second bridge that is also tolled, and there's a lot of lessons from the first road into the second one. But this at the state level. At the federal level in Nigeria, there's really none that's been done, and this is part of what the government is trying to do. So there's a lot they're trying to do to make it easy. The second one I'm talking about, the commitment is the government is going to put 1/3 of the capital as viability gap funding. So there's a lot of that I think is helping us to get through the first one. But it still doesn't make it easy, trust me. It's just a nightmare sometimes.
Des, you've got a...
Yeah, let me add a little bit what Uche said. Actually, you are right. The first projects are the most important one because you are bringing something new, and new is always difficult, and new is always challenging. That's why you need someone like African Development Bank. All those projects in Dakar, 4 of them, we invested only like 185 million into 4 projects from our private sector window, but we facilitated 1.3 billion euro investments in Dakar in less than 2 years. I think one of the most important role we played was not bringing 185 million on the table. I think the most important role we played was the honest broker role. Because when we sit on the table, we are able to tell to investor or the government what needs to be done. That role is very important, and I strongly suggest when you are doing your first project, involve African Development Bank, because we have special relationship with those governments. They are our shareholders, and they know that we will protect their interests, and at the same time, we know that we will also protect the investors' interest. So therefore, I think you can cross that bridge by involving organizations like us, and we sit on a very strong seat. And our actually words are very heavy and powerful. So I believe that we changed the game in Dakar, and anyone can actually prove that, and they can tell you that without African Development Bank, those projects wouldn't happen. Because each of them we approach from the honest broker perspective.
Thanks, Des.
Yeah.
Charles, may you just quickly deal with the gentleman from Ghana about the...
Exactly.
You were chomping at the bit.
No, I was just going to back up his point, the gentleman from Ghana, about the social accounting matrix, about, being able to look at you're issuing bonds, and if you issue bonds generally, right, it goes into budget support, right? And if you issue bonds, generally, it goes to budget support. If you issue bonds specific to a project, it goes to a project to finance a particular project. Then that would enable you to utilize the revenues that you get from the bond issue to actually fund the actual project. But what I was listening to you with interest about was the way in which you have already gone to the second phase of project-specific, like cocoa bonds, for example. And that's what interested me, because I was saying exactly you could do that for project finance. Okay. The other issue that I noticed, and which I noted, was the point made by the gentleman here, who's the lawyer that's based here, who made the point about the government, the government's relationship and the government willing to understand the relationship between the public sector and the private sector. And that's exactly it. And that's why the role that TAS plays with Africa 50 is so critical. I can recollect that between 2005 and 2008, I was the chairman of something called the Pan-African Infrastructure Development Fund, which was an agreement between Nigeria and South Africa to establish a Pan-African Infrastructure Fund, which got bogged down in politics as we included different members who had different expectations and different issues. The other claim to infamy that I have was that I, in the late 1980s, was one of the analysts that did the forecasting for the Channel Tunnel. Now, there is a lesson here, because that was one of my that was my first, I think my second job, and that was my second job between 1988 and 1980. We did all the forecasts here in the city of London of the demand for the Channel Tunnel. Now, we got them erroneously, hugely wrong. The level of mistake in those modeling estimates were wrong. Now, why am I saying and why am I raising this? Not just to pour sackcloth and put on sackcloth, no. The point is that you can sit and have the best intentions, do all your forecasts, measure your user pay principles, analyze, do everything, and you might not be able to foresee that short haul, cheap airfare might change the overall structure of the use of railways to cross from the UK to mainland Europe, and set your modeling and revenue models all asunder. Nobody was able to forecast EasyJet in 1988 to the extent that it evolved. And if you look at the numbers that we did and look at what happened, the revenues from EasyJet, you can see a big hole in Eurotunnel. Now, was the social value, though, of the Channel Tunnel, and that's why I talked about the social accounting matrix, was the social value, what is the social value of the Channel Tunnel? Some would say it's minimalistic. The private sector would say, we're not interested. They would simply say, some of us got burnt by putting in money in investing in this thing we were asked to do. Some of the French would say, ideologically, we always told you that it was something that was meant to have been financed by public funds. And then, if you remember who was in power at the time in the UK, she argued very strongly that the only way to do this was through private capital, and she had to prove her point. Now, I think for us on the continent, we have to be balanced. Some projects need to be funded. Some will require the government and will require the ADB to play this AFDB, to play this critical role, to deliver infrastructure and get us the social multipliers that are so essential. Some of them are commercial projects. Some of them are container terminals, for example, which you can clearly do your measurements. You can see that most people using this are commercial entities, and clearly you can price this, and you can go forward that way.
Thanks, Charles. Yeah. I see the Minister wants to just, before we do that, is there any other question in the room? I see we have virtually run out of time. There's one question there, and then Honourable Minister will allow you
Monish from IFC. I was wondering in this whole discussion about financing infrastructure, what is your experience, recent experience on the role of commercial banks, who traditionally used to be, significant providers of long-term project finance, and who have gradually been taken out of the market because of their own, Basel III related capital and balance sheet constraints. So in what constructive way can the bank's prior experience in project finance, their structuring skills, can be drawn into supporting this effort?
Okay, let me take this. Actually, we've been able to work with commercial banks on a number of projects in infrastructure financing in Africa. You are right, Basel III is crippling their operations. But that's where actually Africa 50 comes as an innovative corporation, because we can provide them partial credit guarantees and extend their tenors, or we can basically give them guarantee to buy them after 7 years. As such, they know that they are getting into the project for 7 to 8 years, and after that there is an institution ready to buy their debt back. And as Charles was mentioning earlier, our goal is actually at that point going the route of project bond. And we already know when we have to buy back that loans, and we can actually forecast in advance, and we can prepare the issuance of the bond. Once the time comes, immediately we bunch few of the projects, and we go to the market and issue a bond, or we sell them to the pension funds.
Roman, you've also had some...
Yeah, I think just to give you a feel, we are currently closing 2 transactions where you got around $1 billion debt, both half in Ghana, half in Nigeria, on the IPP space. We got a mix of DFIs and commercial banks. Yes, there is a capital allocation, but what it means is also that the commercial banks will look on a global basis and will go where the projects are properly structured. If your projects are properly structured, you will have appetite for that. We closed a wind farm in Kenya end of last year. We're closing one this year. There are appetite, but you need to have for the properly project, get the right risk allocation. We're coming back always to the same point.
I think point well made. Mr. Minister there?
Yes, just a quick, comment. Yes, we're moving towards, project-based, bond issues, even if it is general. But I don't think we should also be dismissive of the, bonds that are issued, because they could have a purpose. Let me give you one quick example. Ghana's gas processing plant, which is about to come on stream, was financed 85%, from loan. Right? 15% was required to be financed by the government. The government could consider this as a budget gap, go to the short end of the market, treasury, bills and whatever, a very inefficient way. You raise interest rates, you crowd out. Alternatively, what we did with last year's bond, was to use part of the funds to pay for the counterpart funds in order that you can match tenor with tenor. Because the project originally, until you are able to separate your commercial projects. These are projects that are put on a budget, and therefore smart borrowing would require that, for your 15% counterpart funding, you can go to the bond market, you mark 10 years with 10 years, rather than, go to the 90-day, market. So there is a purpose. Another use of the bonds is to finance, now that you are learning, to refinance bonds which you had already issued at the short end of the market to extend the tenor. So I think that there's a lot of thinking that is going behind this. Yes, we do hear analysts and what they say, which is often, but I think gradually, there will be an understanding, of where some of these, use of funds, are being channeled. And they are being done with expert advice, with advice from, not just, in our case, capital market-based institutions, and institutions like the African Development Bank and the World Bank. So I think that there's a trend that is, going, and I think it will be very useful for the private sector, to work with governments, to enhance investments on the continent.
Thank you very much. Point well made. I think with that we came to the end of a sort of very interesting session. I was going to ask our panelists to leave us with their parting thoughts, but I'm getting all sorts of nasty remarks here in my earpiece that we're over. So please join me in thanking the very interactive panel on my left.